Do you want to get into this housing market, but find yourself wondering if you should be waiting for the crash before investing? Do you expect that housing prices regularly decline by large amounts and for extended periods of time? If you answered yes to either of these questions, you might be suffering from what I have dubbed housing market trauma. And housing market trauma is a condition that stems from living through this severe housing market crash that coincided with the Great Recession in the late 2000s. And although it is really common by most estimations, it leaves people with serious misconceptions about how the housing market works. And as a result, it is preventing many people from investing in real estate and ultimately pursuing a goal of financial freedom. So today we're going to address housing market trauma head on. In this video, we're going to talk about the history of the housing market, whether or not crashes should be expected, and most importantly, what you should do as an investor in this period of rapidly appreciating home prices. What's going on, everyone? I'm Dave Meyer with BiggerPockets, and I'm so glad to be here with you today because so often, whether it's my friends or experienced investors, I hear people talking about this hesitancy to get into the housing market. And I've been talking about it with so many people, I had to put a name to it and ultimately started calling it housing market trauma. And before I get into this, please, as always, we ask that you give us a thumbs up if you like this kind of video, subscribe to the BiggerPockets YouTube channel, and of course, follow me on Instagram at The Data Deli. Before we get into housing market trauma, I want to just make sure and be clear that I am not trying to make light of this. I have experienced personally a lot of financial trauma in my life. And it's one of the things that honestly has motivated me most to be an investor and to pursue financial freedom. So I'm not joking when I say and call it housing market trauma. I do think people are genuinely affected by what happened in 2007, and it has altered their perception of the housing market. And ultimately, we need to correct that. And so that's what we're going to do today. So to do this, we need to start with the history of housing prices in the US, and we're going to turn to the whiteboard to do that. So what we're first going to look at is the median sales price of houses for the United States from 1963 to present day. So that is almost 60 years of data. And when you look at this graph, it should be very obvious to everyone that there are almost no sustained flat or negative periods in the last 60 years in the United States. So if you start in 63 and then go all the way to 1990, yeah, you could see like a little decline here in that recession and maybe a little decline here. We're going to talk about that one in just a second. Then we have the financial collapse of 2007. So that's when you really see things start to decline for a long period of time. And then, not a lot of people have talked about this, but we were in a flat or even declining period from 2017 to about 2020. And so if you look back 60 years, there are 4 periods where you could say that the market went down. Sure, really around here, there's a little bit, but honestly, it's just a little bit volatile and it's not really a sustained period. And so before we jump into more analysis of this, I should note that this graph is not adjusted for inflation, if anyone is wondering. If you want to check out inflation-adjusted home prices, check out the blog called Don't Quit Your Day Job. We'll link to it below. And they have great data there. And it's honestly worth checking out because prices do decline more dramatically when adjusted for inflation. But if you're going to do that, you have to make sure that you adjust all your other financial planning data for inflation too. Because most people, when they look at the stock market or their income, they're not adjusting for inflation. So you either have to do everything or nothing. And for ease of use, and because people are normally used to looking at things in nominal values, which is not adjusted for inflation, I'm going to do that today. So I'm not going to get too complicated. We're going to use nominal values, but if you want to check it out, go to Don't Quit Your Day Job. Let's get back to these numbers here. In the 1990s, in the early 90s, housing prices in nominal terms dropped about 8%. So we're talking about this block of time right here. So right here, they dropped about 8%, but almost immediately. So it was like minus 8%. But then the next quarter, they went up plus 4%. So they almost bounced back half in just a single quarter. And then ultimately, it took about 2 years for prices to return to where they were. So that was a period of flat negative growth in the housing market. Again, that's probably the biggest decline other than the recession. So really not that bad, right? Then we're going to talk about 2017. Starting in 2017, we saw this period of volatility. Interest rates were going up around then, and prices went down about 5 to 7% nationally. And ultimately, it actually took 3 years for prices to recover. And you know what? As an investor, not a lot of people noticed because it wasn't that big a deal that it went down that much. But it is something worth noting because these types of flat or negative growth periods are what I would call normal market cycles. Things cannot always go up. This is how economies work. And even in a healthy economy, prices flatten or decline between periods of economic expansions. And so this is what we're seeing, but it's relatively infrequent and relatively flat. But in the course of the housing market, even because it is relatively stable, these are two of the bigger flat or declining periods in American history. And that pales in comparison to, say, the stock market or cryptocurrency, of course. But what about 2007? That was the big one, right? Well, back then, housing prices dropped 19% nationally. So when we're talking about here from about Q1 2017, which is where we peaked, down to Q1 2019, which is really where it hit the bottom on a national scale, it dropped almost 20%. And that's what I would call a real crash. Personally, I define a crash as asset prices dropping more than 10%. And so by that definition, which is not really that conservative a definition, some people would say 20% is a crash. I would say that at 10%, there has only been one crash on this entire chart. So just keep that in mind. But the really bad thing about 2007, and it was a real crash, is that it took a full 6 years for prices to recover. It was all the way in 2013. So for our other ones, our other examples of normal economic cycles, we were saying 2 or 3 years, things come back to normal. They went down about 4 or 5%. In the big one in 2007, we saw 19% declines and a 6-year recovery. So when we talk about this scale of the housing market decline, you have to consider these two different things. And this is the main point I want to make in this video today. What happened in 2007 was an unusually large decline in housing prices. And that was coupled with the worst recession in US history. Not depression, recession. It was the worst recession in US history, and it was just a horrible time economically. People lost their houses, unemployment was super high, and some people honestly have still not recovered. But just because the last contraction was huge doesn't mean that the next one will be too. I've talked about this a lot in previous videos, but the fundamentals are very, very different between 2007 and now. I'm not going to get into the full detail here, but I do want to provide a reminder about what happened in 2007. And although there were a ton of variables, two that are directly related to the housing market are speculative building and buying and very loose credit standards on mortgages. So let's quickly get back to the whiteboard and look at this data. One of the first things I like to look at here is construction starts. And that's basically how many government permits have been issued to start construction on new units. And we are looking at that back in time to just before the 1960s to present day. And as I said, one of the main things that was fueling the bubble in 2007 was speculative building. There was a lot of buildings. You see from 1990 all the way up to 2007, this massive increase in building. And that's not to say we haven't seen building rates that high, because clearly we have in the past, but they were shorter periods of time. And you see they came crashing down. And that's what happened in 2007, but just worse than ever before. Because although it was really high, look how low the crash goes there. Before, it was bottoming out at around 800,000 or 1 million starts. We were at just above 400,000. So historically low. And what that means is that a lot of builders went out of business. People did not see the profit in doing construction. And so it took years and years and years to get back to where we wanted to be in terms of construction. And this has left a pretty large housing supply in the United States. According to NAR, they think that the housing shortage is somewhere around 5 to 7 million. Freddie Mac thinks it's about 4 million. But either way you look at it, it is very likely, and most experts agree, that we have a housing shortage in the United States. So when you look at 2007, where there was too much building, we have been in a period since then where there's been arguably too little building. And although we are starting to approach rates where we would expect construction to be, personally, I think it's going to take a few years of that before we enter a period where we might be overbuilt. And I should just caveat and say this, that is on a national level. Certain individual markets could become overbuilt. So that's one factor in 2007 that I just don't see happening right now. And the second thing that really, really fueled the collapse in 2007 was loose credit. And there's a lot of ways to measure this. I encourage you to go Google it. You can Google the Mortgage Credit Availability Index or the percentage of disposable income that goes to mortgage payments. But one of the ones I really love to show is mortgage originations by credit score. And credit score is not everything, I know that. But one thing I really like to show here is that if you look down here, this dark blue bars are mortgages that went to people with a credit score of under 620. And that is the definition of a subprime mortgage. You hear that? Subprime mortgages? That's what was going on. People with very bad credit scores who were not well positioned to service their debt were getting mortgages that they frankly couldn't afford. It was irresponsible. And that was a huge part of the collapse. Now, fast forward a couple years, you see this blue bar basically doesn't exist. And instead, you see this light blue bar exploding. And that is people with a 760 plus credit score. People with the best credit scores in the United States are taking on the majority of these mortgages. So what that all means is that people who are taking on mortgages are in a better position to service their debt. And now look, there are other factors that weren't present in 2007 that could impact today's housing market. But I just wanted to show you that given what happened in 2007 and the risks that we found out too late in that market, they aren't really present in today's market. The first takeaway here is that the housing market is going to see flat or negative growth in the coming years. And this is normal. It's to be expected. And honestly, it just shouldn't cause you any panic. Just because prices decline at some point does not mean that this was a crash or that housing is a bubble. And please, when this happens, this is just a pet peeve of mine. When prices do go down, and they will, do not let people who have been calling for a crash since 2014 convince you that they were right all along. This is a normal business cycle, and predicting a crash 7 years ago is not correct. So sorry, that was a little diatribe. But second takeaway here is it is extremely hard to time the market. As I mentioned just a few seconds ago, many prominent investors have been calling for crashes for years, and they've all been wrong. I personally think that home prices are going to continue growing through 2022, but I could also be wrong. It is just super hard to predict the market, and I hope that you don't try, frankly. Hopefully, this shows you just how hard it is to predict the markets, and if you time it wrongly, you could really lose out a lot. So I'm going to just go back to the whiteboard and again look at the median sales price in the US over time. So people think that there might be a crash or a decline, that there is, but you don't know where we are in this cycle. Look how many ups and downs there are in the course of this graph, and that's likely to continue. So we might see a crash, but are we going to see the market go like this and then come down? Are we going to see the market go like this and then come down to this? Are we going to see this? We have no idea. And the point here is that if you look at this first line here, or the second line here, even if you bought right here, which is months or years away, you're still going to be better off buying now than you did in the crash. If you buy right here, and then it goes down, you're going to be worse off, but there's no way to know. You have no idea where in the economic cycle we are. And people like me spend a lot of time looking at data and thinking about when it's going to happen. And I hope I'm right. And often I've gotten it right, but I'm going to be wrong sometimes too. And my philosophy about real estate investing is to just find deals. And if they're good for you right now, just go for them. And that is my third takeaway. If you can find a good deal right now, you should take it. This is a really important opportunity to stay disciplined and work on your buy box. If you're not familiar with a buy box, basically what it is come up with your own criteria of what a good deal is to you And if you find it, don't worry about what's going to happen tomorrow or a year from now. Buy it right now. Of course, you should make sure that you have the liquidity to cover decline so you don't have to sell at the bottom of the market. But if you find a deal that has the cash on cash target you're looking for in the neighborhood you're looking for and supports your long-term goals and financial strategy, why would you start thinking about something that is out of your control? Focus on the things that are under your control. Lastly, don't panic if things go down. The worst possible time to have bought real estate in the history of the US was probably the beginning of 2007. If you bought then, you must have lost a ton of money, right? Well, no. If you bought the median price home in January of 2007 and held onto that property today, you would have averaged a 5% compound average growth rate over the last 15 years. And I know that is not a home run, but when people think about how much money they lost in the Great Recession, well, if they held on and didn't panic and, of course, had the liquidity to keep their property and not sell before they were ready to, they would have earned 5% on their money. That's not that bad as a last case scenario, especially if you add in the 5% you would get on loan pay down during that time, and you're at a 10% compound annual growth rate at the worst possible time to buy real estate in the history of the United States. Throw on cash flow and tax savings and you're well into the double digits return, even though you bought at such a bad time. And I'm not trying to say that there is no risk in real estate. There is absolutely risk. I think being a house flipper right now is much riskier than it has been in the past, in the last couple of years. But rental property investing, where you can choose when you want to sell, is relatively forgiving. As long as you have enough liquidity and cash flow to hold on through a downturn, it's going to work out pretty well for you, or at least it has every other time in the history of the United States. So if you're suffering from housing market trauma, I hear you. 2007 was a very bad, historically bad recession and housing market collapse. It was traumatizing. But if and really when prices go down again, it is not likely to be nearly as bad or as long. Plus, no one even knows when that's going to happen. So don't try to time the market. Determine for yourself what a good deal is. Go out and find something that meets your criteria and then buy it. Don't overthink it. Thank you guys all so much for joining me. I'm Dave Meyer with BiggerPockets. And if you have any feedback for me or any questions, you can always hit me up on Instagram at The Data Deli. I'll see you all next week.